Right now, we want to take you to Carlyle's annual Global Investor Conference down in Washington, and Leslie Picker is there, joins us with a special guest. Good morning, Leslie.
Hey, good morning, Joe. And I am here with Carlyle CEO Harvey Schwartz. First CNBC interview since taking the job as CEO. So really appreciate you joining us today.
Really excited to be here, Leslie.
And a very important day for the markets. And I think you have a unique perspective here. We're, of course, awaiting that Fed decision on rate cuts and the potential magnitude of those. What do you think the economy needs right now, given where you sit atop a $435 billion behemoth, as well as conversations from those attending today's conference?
Yeah, so here at the conference, we have in excess of 400 of our global investing clients. We've come together for a couple of days, really focused on the big themes that are driving markets for the next decade. Changes, really paradigm changing shifts. The shift in globalization, the shift in inflation and interest rates and things driving. Obviously today, with the Fed up, it's getting a tremendous amount of focus. What the Fed does today is not really the most important thing for how we think about the long-term trajectory of our business. We have several hundred companies around the world that employ in excess of 1 million people. And we roll up that proprietary data. And that data really informs us around economic activity. I can tell you when we sat here last year, when market participants, many were calling for 6 or 7 rate cuts, that data was telling us this year we might see 2 or 3.
Yes.
Our perspective right now is we'll see 3 to 4 rate cuts based on the economic health and vibrancy we're seeing in the portfolio really over the next year. So we're not in the consensus of significant cuts. And as far as today is concerned, whether it's 1 or 2, the most important thing for market participants is monetary policy has worked. Inflation's come down, and now we're in this shift. But whether it's 1 or 2 today, we'll see.
So you think it's going to be 3 or 4 by September of 2025?
Right now, when we look at our portfolio of data and the factors that affect the economy locally here in the U.S. and obviously globally, we see a vibrant economy. It's definitely one that's cooled. As I said, monetary policy has worked. I think the Federal Reserve has done an amazing job with a complex set of circumstances. But we see 3 cuts by the end of this year and then perhaps a pause. Economic activity should stay robust. Activity levels should continue to pick up, and then maybe 1 next year. But again, this is out of consensus, and your crystal ball is as good as anybody's.
I want to ask you about private credit. Amid today's decision, you are building out your credit business. Private credit largely flourished as rates jumped. Now that we're looking at entering a potential somewhat easing cycle, and rates are potentially coming down, there's more competition. Can you explain a little bit more about your strategy here? And are you worried at all that you could be behind the ball here?
So our business, as you mentioned, is $435 billion globally across private equity, credit insurance, and our solutions business, our secondaries business. The largest segment of our business is actually credit insurance at $190 billion. In terms of the trajectory of that business, when you think about things that drive the opportunity set for all market participants, it's really the need for private capital. That's what drives it. And we see the trajectory of that continuing to grow. And that is really just not about, for example, in private credit, you really have to think about credit across the whole landscape. Direct lending, high yield credit, asset-based finance. One of the fastest growing businesses at Carlyle is the asset-based finance business. You saw recently we bought the Discover student loan portfolio, $10 billion asset. These businesses have huge momentum, and there are a number of factors that really will keep that momentum growing.
And on the private equity side, you mentioned those portfolio companies, and they're helping kind of inform your view on the economy, suggesting that the economy is robust. How would you characterize their growth prospects, especially as we've seen limited numbers of exits in the broader private equity landscape, as well as fundraising that's been a little bit more muted for Carlyle specifically? That was the case in Asia. Would you say that there is a bottoming in the private equity world right now?
So at Carlyle specifically, last year was our 3rd best fundraising year ever. I think the team did a fantastic job. We've raised over $40 billion in the last couple of quarters, and we're at record assets. In terms of activity levels in private equity, you have to take a step back and realize we went through a period of 30 years of declining interest rates, bottoming at 0. And then we had a shift of 500 basis points. If we were sitting here at this conference a few years ago, that would have been a 1 in a million statistical chance. It's not surprising to anyone, if you would forecast that happening, that activities would slow, market participants would want to recalibrate how they want to think about capital deployment. Buyers and sellers certainly would hesitate. Now what we're seeing is you see more certainty in terms of an expectation around interest rates, inflation coming down. Now you see activity picking up. So we see the pipeline of exits, acquisitions, and you've even seen it over the last several weeks in terms of activity levels. But as long as we don't have an unexpected market disruption, activity levels should stay reasonably robust and improving.